All right, it's 3 on the dot. Let's get this webinar started. For those that are coming into the room, welcome to this webinar. Let me get my microphone closer to me. I hope that everyone is having a wonderful afternoon. Today, we're going to have a great presentation on options trading by our guest speaker, Brandon Wendell. He's a trader and an educator, and we're glad to have him. And I'll pass the microphone over to him in just a moment. I just wanted to talk a little bit about what we're doing at TradeStation in terms of education related to options trading. If you haven't been to the Options Education Center, I encourage everyone to do so. There's a ton of educational content. So I was just saying that we are creating a lot of content on options education. So I want everybody to take some time and explore the Options Education Center. It's pretty much divided into 2 sections. You have the articles right here at the very top that are focused on particular multi-leg advanced option strategies. And you can open up these articles and you'll have access to workspaces. Sometimes you'll have access to custom studies. So there's a lot of information that you can bring into your own TradeStation platform and start practicing right away. And below that, there's a section for webinars. The webinars that we're doing on these specific strategies, of course, are being recorded. You can come here and watch them, play them back at your own speed, and learn from all the information that is shared in them. Today is a kind of a separate webinar that we're starting today. Anybody that's listening in, this is going to be a recurring presentation, meaning that we're going to do it bi-weekly. So if you're attending today, we encourage you to also mark your calendars for 2 weeks from now. Next, I believe it's September 30th at 4 p.m. We're doing these at 4 p.m. And the purpose of this session is just to give you some practical information on option strategies. Of course, the week is starting, so we're going to take a look at what happened in the markets the prior week and see some of the option strategies or some of the trades that could have been placed and the performance, whether it's a trade that performed well or it performed bad. And we're going to take a look at the reasons for, a trade working and it not working. So, and our guest speaker, as I said at the very beginning, is going to be Brandon Wendell. He's a trader and an educator, and he brings a lot of experience trading options, and we're going to hear him out in just a moment. But that's the Options Education Center. Let me go ahead and go through some of the disclosures of this class. Just keep in mind that every symbol and idea that we talk about is for educational purposes. These are not recommendations of TradeStation. We always want you guys to be aware of the risks that are associated with trading options. Has a higher degree of risk. And when we look at examples and performance, this is no guarantee of future performance. Let's all keep that in mind. For additional details, go to www.tradestation.com/important-information. And also, Brandon Wendell, even though we have him as a guest speaker, his ideas are his own. We don't endorse his ideas. So we're glad though to have him here in this webinar for him to share his expertise with us. But we just want to make that clear that he is not associated with TradeStation. So, okay, that's it. Thank you so much for your time. Again, Brandon Wendell is our guest. Brandon, you're there. So I'm going to pass the microphone over to you. Thank you for joining us.
Thank you for having me. I really appreciate being here and being here with everyone. I'll go ahead and share my desktop. Actually, I got to do a request, I guess. Get that set up there. And voila.
Yep.
Should be able to see mine. Perfect. Okay, great. Let me make sure I can see the chat too, because I want to make this interactive as much as possible. Yeah, so this is your series. And as Jesus was kind enough to introduce me, my name is Brandon Wendell. I am a chartered market technician, which basically means I've got kind of a master's degree in technical analysis. Chartered market technician designation is something I attained many years ago to gain more knowledge into how the charting and technical analysis works. And I still try to keep it as simple as possible, even though I've learned quite a bit. And I want to share that with you in this series. But mostly we're going to be focusing on options, obviously called options replay. We're going to be looking back at what could have been or what has been and what might be possible in the future using the TradeStation platform, the TradeStation options platform, OptionStation Pro. and TradeStation itself is pretty powerful. So I actually have logged into, let me see, there we are. I actually realized that I switched computers. This is my normal trading computer that I work on for my trading and whatnot. And I didn't have all the workspaces downloaded, but that's easily remedied because TradeStation was kind enough to create education for you. And it's right here, basically on the Options Education Center. And what I can do, just as you can, is go to that page and do what I just did, is download a workspace. So depending on which security or which strategy you're looking at working with and learning more about, basically it's under TradeStation, you go to learn. On the Options Education Center, you can see that we have tons of they have tons of education. I say we because I feel like I've been doing so much with them. But for instance, if you're learning more about iron condors or butterflies, you can click on the link and it'll take you to the page where I can download the workspace. And I'm not just doing this to kill time. I'm actually doing this because I need to download the workspace. It's just that easy. So I click on it, and right here, it'll bring up the compressed file, which I actually have popping up on my other monitor here. And right there, you click on Iron Condor, the one I just opened. And there is the workspace. So it's all available. So basically, these are workspaces that allow you to identify potential opportunities in the markets. There's never any guarantees. It's not 100% perfect, but it's one way of utilizing the tools involved in TradeStation to, say, find an iron condor or to find a bull call spread or whatever else you're looking for. Condors, straddles for earnings, all sorts of things that are available there. And the original recordings you're asking about, Kevin, there are many of them out there. If you want to search, you go by topic right here. So for instance, again, if I go back to the main page, you'll see as I scroll through, and they're going to be reorganized as there's more and more topics being added. They're going to be brought up into different categories. Today's date is 9/16, I think. Yeah, 9/16. So this will be in the events, which you'll be able to find. When you go to the events page, you'll see the past pages and past events and whatnot. So you'll see these available. We're going to do this every other week, as long as you guys like it. And please give us feedback. Let us know what you like to learn, what you would like us to focus on, and what you need help with. Because, we're not here to advise you on individual securities. I can't do that. I'm not licensed. I don't do that kind of stuff. But I can talk you through the platform and some of the opportunities that are out there, how you would be able to manage them on the platform itself. So for instance, let me go to apps and open up my OptionStation Pro. There it is. Because I literally was working on my other computer, which is to my right. I've got a wall of monitors here in my log cabin in the woods. Let's see. Where are we here? Loading up, loading up, loading up. And as soon as it loads, I'll be able to continue working with you on that and show you some of the positions that are currently open. I was mentioning events and things that are happening going forward. Just closing a few other things here. There we go. Oh, that's right. I don't have my background showing of the other one. Anyway, where was I here? OptionStation Pro, there we are. And I have under manage right now, several positions that we can talk about and look to see, how they performed in the past and how they might perform going forward and why they were put on. And of course, how you can utilize the platform to do that. So I was mentioning before, when you go into the Options Education Center, for instance, bear call spreads, you can click on that. And there are the webinars that were done in the past. You can watch the webinars. You can explore the strategy more. There's a PDF article that walks you through what that strategy is, how it's deployed. But what we're going to be doing, and of course, I can download the workspace if I don't already have it. Let me just make sure. I'll save it in my downloads. And there. Double click. And because I had the platform open, it'll automatically download and upload the workspace. The other nice thing is there's a PDF. If you're not familiar with that particular workspace or the tools involved, right there, Bear Call Spreads workspace instructions. When I downloaded that file, it also downloaded that workspace. And there's actually a tool, an easy language tool that was created specifically for that workspace that's also automatically imported, or not imported automatically, it's downloaded. You can import it yourself. And there we go. So what I have as far as a strategy, and I also want to talk about a couple things coming up as well. So let's see, why is option leg price indicator strategy not promoted? For trading the option derivative near as much as it is for trading the underlying itself. I'm not sure what you quite mean by that. Do you need a margin account for these strategies? Some you do, some you do not. You got to contact the brokerage. Also in TradeStation, there should be a list of the different margins that are required or not required under options pricing. Remember, I don't work for TradeStation. I'm just here as an educator to talk a little bit more about the strategies themselves and how to employ those. But yes, if you go into, for instance, option margin requirements, you'll see that if you have to put in 100% of the cost of the option, you're basically buying the premium of the option. I don't know if you need the margin account or not. That's something you have to talk to the trading desk regarding. Okay. I can't tell you or not. As far as what we're doing for the indicators, typically the way I look at trading options is that I look to see, I do three things. Number one, I try to identify which direction the underlying security is going to go. Am I bullish? Am I bearish? Or are we likely just to go a little bit sideways? You know, there's a new workshop coming up pretty soon. As a matter of fact, let's see, I went off the page for it, unfortunately, but it was under events coming up. There's one on calendar spreads, and that's actually one of the trade opportunities I put on. And there it is, coming up on the 30th. So the next time we get back together is actually Monday the 30th as well. It'll be later that day. That webinar with the guest speaker, I think it's from the OIC, Matt Cashman, he'll be coming in and talking about calendar spreads and balancing risk and reward. And I'll be going in a little bit later, again, meeting with you guys, going over trades that we are going to be looking at for the next couple of weeks and identifying, you know, again, what worked, what didn't, and how to place those. But one of the trades that I wanted to go over today is actually a calendar spread. Okay, now before I go any further, again, let me find, oops, that's not what I wanted. I want to open a new page right here. There we go. And basically, when it comes to kind of the way I'm viewing a lot of the options, and this will kind of answer the question, when I'm trying to figure out what am I doing, I chart you don't chart the option premium that often, you chart the underlying. And the reason why is for options trading, and there are many different ways of doing this. Just because I'm specifically mentioning this one way doesn't mean it's gospel, so to speak, okay? But basically, when it comes to options trading, number one, you know, I evaluate or analyze the underlying. And, you know, I joke around, I say it's kind of like Leonard Skinner, give me 3 steps, right? 3 steps in this options trading is number one, what is the underlying security doing? You know, are we seeing a bullish move? Are we seeing bearish? Or are we just going sideways, maybe range bound? You know, what's the direction? What's going on? Number two, once I figure out which direction the underlying security is going to go on, because when you think about it, when you're trading options, options are a derivative. They derive their value from this underlying security, whether it's an index, whether it's a futures contract, or whether it's a stock or an ETF, right? So we do most of the analysis on the underlying security rather than doing the option and charting the option price. You can chart the option. Okay, the premium, you can chart that, but it's not really useful for the most part. For the price of the option, actually, you don't necessarily need to underlie, you can analyze the underlying price. Absolutely, you can. So again, let's go ahead and do this. Number one, we evaluate the underlying. Number two, are options cheap or expensive? Right? So don't worry, I'm going to answer the questions as I go through this, and I'll define what trend is as well. That's a whole other discussion, but I'm not going to get to all those questions right now. So are options cheap or expensive? Obviously, if options are relatively cheap, we usually want to buy or do debits, right? Buy or debit. Now, that's the interesting thing about options. You could be bullish and sell. Meanwhile, you know, typically when you're dealing with stocks or futures, if you're bullish on something, you would just simply buy it. Here, you could be bullish and sell or bullish and buy. Okay, so either buy or debit. If actually I should do if options are cheap. Now there are always exceptions. Okay, this is not always the situation. When it comes to technical analysis in markets in general, everything always happens except for when it doesn't. So typically, if the options are relatively cheap, then we want to buy them or use a debit type strategy. And then number two, if options are expensive, well, then we may want to sell, right? Or credit strategies. Now, what determines if they're cheap or expensive? Well, that actually goes to the value of the option. You have a couple different ways of evaluating that. One is implied volatility. Okay, and we're going to talk about how we can use those to identify which particular options that we may want to choose. Okay, and another thing that we can compare to is the market value versus the theoretical value. Right? If you take a look and you can see that something is theoretically valued at a higher rate than you could currently purchase it, then you probably want to buy it, right? Absolutely. Options price. Now, the problem is if you chart the options price, it's not right. You're not going to get the same kind of technical analysis you need. Okay, that's what I'm saying. I can show you what it looks like. It doesn't look the same as charting the underlying. However, you can go ahead and take a look at the theoretical value and take a look at implied volatility, which, yes, it's derived from prices. Absolutely. So if we're seeing that implied volatility is relatively low. Now, when you think about implied volatility, I said relatively low. Implied volatility could be low at 14%, or it could be low at 140%. It depends on the individual security. Again, if implied volatility is relatively low, then options may be less expensive. Again, it is not always the case because what is relatively low could go lower, of course. And what we're looking for is something to go a little bit to the upside. If we're buying relatively low options, we would like that to go up in value, and the volatility rising could cause the prices to go up in value as well. If it's relatively high, well, options may be expensive. I cannot spell today. There we go. It's the first class jitters. There we go. I'll just blame it on that. So right there, we have the relatively high, relatively low with implied volatility versus previous or average or against historical volatility. So there's a couple different ways of comparing that. Actually, grammatically correct. There we go. Versus previous range or average or historical volatility. And then finally, once we figure out, okay, what's going on in the underlying security, then I need to choose the correct strategy based on the market conditions and what I think the market is likely to do in the future. And depending on how good I was with my analysis, it might work out great, it might not. So I mentioned that, starting off, we could take a look at things like these different workspaces. And actually, I don't have the calendar spreads one with me right this moment, so I apologize, but I can look for, let's say, volatility. Okay, we have right here, for instance, the straddles for earnings. That was one of the very first workshops that was done back in January, I think, of last year. Or was it this year? I don't even remember. It's been so long ago. But anyway, there was a volatility straddles for earnings workshop. And again, it's in the Option Education Center under Learn. And even in the past events, you can find it as well. I go all the way back here. Where are you? There it is, straddle opportunities for earnings. Okay. And there was a redo basically that was updated with David Russell recently, I believe, as well, which is really nice. But one of the things I was looking at is I can take a look to see, okay, what's going on with volatility, percentage-wise, implied volatility. And there's one indicator here called IV range percent. And I believe on my watch list, I got to populate and fix this a little bit more, but that's okay. I can take a look to see how is the current implied volatility versus the historic volatility. And we can measure this out and see if we have high or relatively low volatility, as well as good open interest and a few other things as well. Actually, let me go to a different page here. We'll go to this one. because I know this one works right now with the volatility. So for instance, I just happen to be on EWJ, which is an ETF, which follows Japan. And by looking at the volatility right now, I can see that implied volatility for all options, and there's several different tools that you could possibly use. I just happen to have two selected here, implied volatility versus the average. And we can see that currently implied volatility is high versus the average. Well, if implied volatility is relatively high, my list says, well, we may want to find something that we could sell, because we are seeing that options are relatively expensive. And when they're expensive, selling or credit spreads are possibly the better choice. And of course, we could actually kind of test this out going back to the theoretical value. Again, I'm on EWJ. Now, the next piece here, looking at implied volatility versus historic, doesn't really look like it's all that high. It's kind of in the middle of the road. So even though it says that these may be a little overpriced based on volatility, they may not actually be overpriced. So I go to the Option Station Pro and my options chain, EWJ, and there's so many different tools that you can populate here. One of them, first of all, if you're not familiar, in your options chain, let me get rid of some of these because I have way too many. There we go. When I go to my options chain here, first, I can customize all the columns if you're not familiar. So a little wrench on the right-hand side under customize columns, I put in the Greeks, the main ones that I look at, which are delta, gamma, theta, and vega. And I don't look at rho, although that is something that may become a little more important to us on Wednesday, which we'll talk about in a moment, okay? And right here, I can add in theoretical value as one of the top, or not topics, but it's one of the things I can put in there. I can even look at implied volatility and implied volatility skews, things like that, if you choose to. I just want to keep it somewhat simple for now. So let's say we were going out just 30 days. And I can see that, okay, remember, EWJ showed implied volatility is currently a little bit higher than average. And if we go back to that chart, it was showing 23%. I know it says 0.23. Those are usually expressed as percentages. The average shows 21% based on that indicator. And again, we can adjust the indicator based on our needs and what our viewpoint is as well. But currently, if I were to buy the at the money call at 70, we could see that I would be, basically they're asking 250. Well, the intrinsic value right now, or theoretical value, not intrinsic, the theoretical value is $2.21. Well, that means that it is a little overpriced, isn't it? Even the bid price right now, at which I would be able to sell quickly. Now, I can state the price I want by using a limit order. You know, just because I click on one of these to buy doesn't mean I actually have to pay that price. I can do natural price. I can adjust to what it is that I want and use a limit order to get filled or not. Remember, limit orders, no guarantee. You're specifying you want that price or better. If I hold out for 221, it may never happen, right? And I have to go by nickels, actually. The intrinsic, the theoretical value may be at pennies, but when you're dealing with these options, you have to trade in nickel increments here. But yeah, I may not get filled because if I put in a limit order 221, yes, I'd be buying way below what the market's at right now. But remember, the implied volatility is currently a bit high, so I would prefer to sell above that value. So 235 is slightly above. I'd prefer to sell at something a lot higher if possible. Okay, this is just slightly elevated as far as implied volatility and pricing. So again, if I go back and look through some of those scans, and we can even look at right here, there are hot lists. It depends on the security and the value of the securities, whether you trade in pennies or if you trade in nickels. Again, it's just the way the exchange has things set up, okay? And not all strike prices are available as well. There may be dollar strike prices, and maybe $2.50, and maybe $5 strike prices. It depends on the value of the security, the underlying security, what it is you're trading. So that's what it is. As far as the best amount to get started trading with, it's whatever you feel comfortable with. You know, and you need to be able to deal with the issues, especially if you happen to be selling any option, even if you are covering it with another option, you still have to be able to deal with the assignment. So make sure whatever capital you're deploying, you have enough in there that should you take any losses in your security, in your trades, that it's not devastating to your account. You want losses to be minor setbacks, not major dings or crushing you. For instance, if you were to lose $100 and you only had a $1,000 account, that's a big chunk of your money. It's psychologically damaging. But if you had a $100 loss on a $50,000 account, the sting is not as hard. Still doesn't feel great. Nobody likes to lose money. Does anybody enjoy losing money? Show of hands. No, nobody ever raises their hand on that one, right? If I ask who's good at it, yeah, I get it. Anyway, I can look at different things. Right now, what we have set up is a hot list, and you can actually go in and add hot lists as a new page inside of the radar screen. That's how you do it right there. You can either add in your own symbol list that you create or ones that are already created. You can create a blank page and add your own symbols or hot lists. And many of these pages have already been set up. For instance, Iron Condor, Iron Butterfly, that's typically a strategy where you want to find high volatility that's getting ready to drop. So right now we have the implied volatility percent change up. Makes sense, right? We're going to try to find securities that have potentially high implied volatility compared to their average. Look at this, FNF, for instance, 83% implied volatility right now on the options. As a matter of fact, can I zoom in there? There we go. That looks better, doesn't it? Hopefully you can see that when I zoom in. Anyway, you can see that implied volatility, all options at 83% right now. The average implied volatility is only 37%. Wow. Okay. And there's a ratio of implied versus historic. That's pretty large too. That means implied volatility is extremely high. And because implied volatility is very high, the options may also be overpriced. And you notice I say may because there's no guarantee, but this is just one factor. So looking at the options chain for FNF, let's see, I didn't load it up here. So let's go ahead and do that. As a matter of fact, let me go back to my other page and I'm going to do a global link. There we go. Click one. Is it loading? Hopefully. Anyway, there we go, FNF. And now when we start looking at implied volatility, or not implied, but excuse me, we look at the pricing, the ask for the buy price or the bid for the sell price, and compare that to theoretical value. Let's do a put this time. Okay, right now, the at the money puts 60, because we're trading at 60.61, that's at the money. I know it's slightly out of the money, it has no intrinsic value, right? If you're familiar, intrinsic value is how much in the money that option would be. Well, a put is in the money if the current price is under the strike price. It's not, it's above. So that has zero intrinsic value. Well, if you were to take zero, subtract it from the pricing, that means that has 100% time value. Or yeah. So basically, they're saying right now, this one, theoretical value is $1.07. Well, that's kind of in between. That's actually fairly priced, right? Well, if we can find something that is overpriced, and this is what I said, it doesn't necessarily mean that you are going to automatically see high volatility mean expensive options. There are other factors that go into that, but we can look at least and get an idea. And we see that, well, if we go to another put right here, 1408, again, right in between. These options are trading pretty much right at their value. Now, this is also a factor of the fact that it's after 4 p.m. The markets are closed. When the markets are actually open, you'll get some different numbers there as well. As a matter of fact, I'll do it another time. We'll go into options on futures another time in another session, and I'll show you the TradeStation Futures Plus and how we can do options on those as well. Okay, but you'll notice I brought you to FNF because, again, the implied volatility was somewhat high, and you'll notice there's a -1 right there. And that's on this October option that has 31 days left until expiration. If I go out a little bit further, oh, no, it's over here. It's right there. On the March 2025, I have a +1. Well, I put on a calendar spread, and we can actually see this. If I go to manage, these are the open positions that I currently have right now on this platform. And right here, unfortunately, it's a little negative, but there's a lot of time left. This is a calendar spread that was put on. And one of the reasons why the calendar spread was put on was to take advantage of time decay and going back to that security FNF. Remember, step one is I go to the chart typically and see what's going on with the security and what is likely to happen. Well, we can see that we had gone through a channel for quite some time. And actually, originally, I saw that this was in the channel. I was expecting it to either stay in the channel or possibly move to the upside a little bit. As you can see, it moved up quite a bit. Okay, so going back, let's see, does it show the date that I entered? Trying to remember if it does. I know there's a way of seeing it. I cannot recall where it is. I don't want to have to go back. I probably would have to go into the history of the security. And I'll do that another time with you. By the way, if you want to chart, right here, you can see there's the option symbol. And you can actually chart the premium of the option itself. And it'll be completely different than what you're seeing when it comes to charting the underlying security. So for instance, I can copy the symbol right there, copy symbol. The way it's set up, by the way, is the symbol, FNF, the year, 2025, the month, 03, always 2 digits, the date of expiration, call or put, so C or P, and then the strike price. And that's the standard format. So if you wanted to chart this, just go to a chart. You see, I have one chart. And right now we're charting FNF. But I could put in the symbol, and that's part of the reason why you don't typically chart the premium. That's what it looks like. Yeah, I could change this around. If I go from style, we can go to line or an area chart, and it might look a little bit different. But overall, that's not really all that great to look at. Yes, I could possibly compare it to theoretical value, but I'm not sure if I can actually chart the theoretical value on here. Okay, you have to see if you could add it in. I don't think it's an overlay that you could actually add. So that's why we actually chart the underlying security. And then to figure out, okay, how do I want to trade this once I know which direction this security is likely to go? And like I said, when I originally put on this idea a little while back, we were looking at a chart like this. We had relatively high implied volatility. Option prices given delta is still better than underlying? Not necessarily. Not sure how you would compare that other than compared to the theoretical value. But the reason why I selected this particular strategy for this particular security was, again, you can see it's basing, breaks out, basing, breaks out, basing, breaks out, basing. So the idea behind the calendar spread, and again, you're going to learn more about this as the education comes out for that, is that you're taking advantage of something that typically is stable in price. However, with calendar spreads, you can also go directional as well. So I chose a call option, and here's why. Take a look at the actual position. I am long March 2025. Okay, why? Well, I'm bullish long-term on that particular security. If again, you look back at the chart, and not even the smaller time frame chart, but you go to the larger time frame, where is it here? FNF, right there. You can see this is a very strong bullish trend right now. Again, bases, trends, bases, trends. That's what it does. So that's what I'm expecting is the end of this basing pretty soon and potentially sideways trending for a little bit. Now, somebody asked earlier about trends and how to identify trends. Keep it simple. Honestly, keep it as simple as you possibly can. The definition of an uptrend is a series of higher lows and higher highs in price. Well, we have got that, higher lows. One exception there, did drop down a little bit, but overall, higher lows and definitely higher highs right now. I can have certain tools that I use, and one of the tools that I actually do add is the RSI, but I don't use the RSI in the typical way that most people use it. So right here, I go to RSI, which if you're not familiar is relative strength indicator or relative strength index, depending on who you ask. And I do modify it just slightly. Okay, and the modifications I've done here are 60 and 40. Overbought is 60, oversold is 40. Okay. And I've learned this many, many years ago as I was becoming a charter market technician. You got to realize trends, people kind of look at these indicators wrong and read price. I guess they misinterpret, let's put it that way. I'll be polite. And what happens often is that people think if something's overbought, it's got to come down, or something's oversold, it's got to bounce. No, overbought can become more overbought. That's the nature of a trend. Oversold can become more oversold. That's a downtrend. So what I'm really looking for is signs that the trend is losing strength. You think about it, it's like a bridge. Okay, let me go and bring this indicator in, actually style, thicken the line a little bit for the RSI, and let's make it a nice, well, actually I'll keep it that color because it does change. There we go. And there we are. So right now, you can see it's going in the overbought area, but what's been happening? We keep going higher. Why? Because that overbought shows there's a lot of bullish pressure. The way I look at price is that this is the support. That indicator on the bottom is a support. This is the bridge. So when prices are moving higher, it works the same way for downward too. Actually, let me pull this back a little bit. Yes, this is recorded. Absolutely, 100%. So as we're moving up, for instance, you should be getting lots of bullish momentum to propel prices upwards. If for some reason prices go up without the supports, what happens if you have a bridge without supports that are touching it? It's probably going to fall, isn't it? And right there, you can see that we're moving up. We still had good support. Here, we failed to go red again, didn't we? For the first time in that entire sequence, we didn't go and become overbought. That's weakness in the trend. And sure enough, we actually snapped the uptrend. You can no longer be in an uptrend here. It's impossible. You know why? Because you can't have lower lows in an uptrend. So right here, you made a lower low. You're no longer in an uptrend. As a matter of fact, the RSI told you that as well. It warned you before it happened. In a downtrend, you should be seeing lots of bearish pressure. And we still are. Still going down. Notice we go down again. But here we have a problem. We've made about the same lows in the indicator and the price, but we did not on the indicator. We lost a lot of that support. That means this downtrend's in trouble. And look at that. Now we failed to go below 40. And guess what? The trend is over. Notice now we have higher low and higher high. Isn't that cool? Price tells you what it wants to do most often. Not 100% of the time, but often. And actually, we go back there for a moment. We did make the higher high. We did come back down. We actually made the lower low still one last time. Okay. And then we finally started the uptrend. So my point, and by the way, this is on a weekly chart, longer term. My point is that looking at this, this is a very strong uptrend. So I anticipated it was going to continue to go in the uptrend, which it will until the end of the trend. And momentum, as well as price, will typically tell me when that trend's likely to end. So I chose that. Number one, I was bullish on the underlying security. So for FNF, again, actually, we'll do it this way. FNF, bullish with sideways movement periodically. Number two, are the options cheap or expensive? Okay, well, take a look at them. Again, going over to the option pricing, actually before the option pricing, going back to the chart itself and looking at volatility, while this was still in the sideways range, and for some reason it's not giving me good data right now, that's just an error, but that's not normal. But the implied volatility was actually relatively high, and therefore options were short-term pretty expensive. But typically what will happen is if prices continue to climb gradually, as they have in the past for this security, volatility will decline. So I decided, well, calendar spread might be pretty good because long-term, this is a bullish trend that we're likely to continue in. But short-term, we may get some sideways interruptions and a drop in volatility. Well, when you sell an option, basically I did both here, right? I was buying long-term. And the reason why I was buying long-term for the bullishness, for that bullish move. But at the same time, I was going to sell short-term. And why did I do that? Well, because short-term implied volatility higher than average. And sideways price movement. And again, we're going to go through, like I said, different opportunities and look at different reasons why you might want to choose certain strategies over others and how we actually would put those trades in. So I was taking advantage of both the long-term bullish move as well as the short-term drop in potential volatility because we were already a little bit overbought in the volatility. And going back, I don't know exactly what the option implied volatility and pricing was, but I do know it was above. I was able to sell at higher than intrinsic value, or sorry, higher than theoretical value. So even looking at it now, let's take a look. Right now, look at the theoretical value, 193. Okay. And of course, again, the markets are closed right now. I forgot to take a picture before the markets close. Next time we get that together, I'm going to have some screenshots of when I put in the positions, what they actually look like as far as the trade ideas. Let me check on my other computer because I might actually have them for this. If not, again, I'm not going to spend time looking for it too much right now. I'll just bring them in next time and I'll have them already prepared for you. So you can see exactly what I was looking at. But at the time, like I said, the theoretical value was below the bid and ask price. That means I could sell at the bid, for instance, here, 55. That's $6 just at the bid price. There's a 50-cent spread right now. But if the market were open, it was probably smaller. And the theoretical value was under that. Well, if you could sell it for more than the value, that's a good thing. Then long term, if you can buy for less, see this one's showing the opposite right now. Well, yeah, you buy for 530, it's only worth 460. But at the time, if you could buy it for somewhat less because the implied volatility is skewed a bit, maybe towards the front end, seeing implied volatility higher, closer, for instance, here, comparing, let's say, the 60 right now. If you were to sell or even buy, you're buying above the theoretical value, right? You're paying what, 70 cents more. If you were to sell here, you're actually selling a little under, over. You're selling over value, right? Why? Why is this one selling for more than the theoretical value while this one was selling for under? Look at the implied volatility. The implied volatility was higher on this front month than it was on the far month. So taking advantage of that, there was an opportunity to sell potentially, if we were to do the same thing right now, a calendar spread. Let me do a different strike price so they don't get overlapped here. Although I don't really have, yeah, we can do that. If I sell the 55 and buy the 55, I wouldn't want to do this necessarily right now because if you're buying 990 when it's only worth 788, right? What did I do here? Strike, get rid of that one. There we go. And there's a calendar spread. See, it recognizes a calendar spread because what I did to create this, by the way, I just hold down the control key when I click on either the bid to sell or the ask to buy. And it loads it up in my chart and I can click analyze. Okay. But basically, I wouldn't want to do this one in particular because I'm buying it, what, $2 over value? No way. And I'm only selling it 25 cents over value. I'd want to get a better skew if possible. Okay. Is it possible for a retail trader to become profitable a long period of time? Yeah, why not? You don't have to be institutionalized. I mean, you may become institutionalized if you trade too much and go crazy, but no, I'm kidding. There's orders or orders. it doesn't matter. They're blind as when they go into the specialists and the exchanges. It doesn't matter who is who. It goes by first come, first serve in price. So yeah, there's nothing that you have to be professional that gets prioritized. Okay, there shouldn't be anything. And if there is, I mean, it's when they used to have the floors and people trading in the pits, there was an advantage. Yes, if you're on the floor yelling to somebody that can see you and get the order filled faster, everything's electronic now. There should be no prioritization of those professional orders versus non-professional orders. So you should be fine. Okay. I used to work as a agency desk operator. So I worked with market makers dealing with equities back in the day when it was monochrome monitors, if you remember those green CRT monitors. So, I mean, things have changed since then, obviously. But yeah, I used to deal with a lot of market makers, and I had friends that were too. But, overall, you should, yeah, the 390 professional orders rule, professional traders do not receive priority over retail customers. Yeah, they should not. Everything should be fair and equal. It's actually, I think, a little more level in the futures market sometimes than it is in equities, just from watching and exercise and seeing it. Anyway, getting back to this strategy, again, placing the order is very simple. I can put it all together like this. Now, counter spreads, as you'll learn, are a little tricky because when you go to analyze, for instance, and I got to take off the other one that's being shown right here. Let's see, why is it? No, calendar. Hold on, let me try this again. I think it's showing. No, shouldn't be. That's weird. Might be better to do a different security, actually, just to show. Is it getting this overlap for some reason? But I'll try it one more time. It's not show. Oh, that's why it's showing delta. That's what it is. Theoretical value. That's better. So this basically, it's a little weird when it comes to these calendar spreads because of the way they look. You can see that it's a strange risk profile. This would profit basically from the option that I sold expiring completely worthless. And if I can sell it above the theoretical value, that means I can potentially get a little bit extra. Okay. So that's an advantage. Not only that, but when this one expires, think about this. Oh, wrong page. If I go back to options, that $7 I'm collecting lowers the cost I'm paying for the one I'm buying. Right? Theoretically, once that expires, that premium is collected, goes into the account as long as it expires out of the money. Now, if it expires in the money, then we have other issues. Obviously, I have to either be able to deal with the assignment, or I have to exercise and try to limit my risk. So that's one thing that we can deal with. And one of the reasons why I decided to do, I was on the right page here, sorry, back to manage with FNF. And I believe the other one is Apple and American Airlines. I think that was just a covered call, nothing big there. But the nice thing about this covered call is that I'm lowering the costs and protecting my security just slightly. And we'll cover that in another day. I don't want to cover that right this moment. I want to focus on these two right now. It looks like they're losing money, but in reality, it's just biding time. Okay, FNF, I have the 60 calls. Yes, it's slightly in the money right now, but if prices stay relatively stable and eventually by the expiration in 31 days, if we are below $60 per share on FNF, and or if the volatility drops before we even get there, right? This is what I can do is, again, go back onto this position, and under the analysis, we can go back and take a look at how this position is actually going to benefit, which is what we're doing here. So we go to that position, get rid of the old one. There we go. And now you can see how time benefits, time decay. It's working this way. This is the current price in blue. Again, I can zoom in so you can see it better. Okay. And you can even see, I forgot about this on the option statistics, you can kind of see where we are with implied volatility. And it's currently lower than it has been in the past. So implied volatility has already started to drop, and that implied volatility continuing to drop will help the position. I can't zoom in that much. So right here, if I start going, let's say negative 1%, even if prices don't move, this starts to profit. Let's say if we go down 5% implied volatility. So not adjusting. Oh, I know why, because that's the wrong plot. There we go. Last. And again, 0. So as long as there's still time left, right now I have -2, and that's what we're seeing. My position is down by about 2. But if I get implied volatility going in my favor, it's +1. Let's go -1. Didn't change much. Go to -5. Come on. Plot 3. There we go. Time going by and decaying, and implied volatility dropping. Even if prices don't move, this is going to start profiting. So even if it is still in the money somewhat, as long as that implied volatility collapses, as it has been doing, this position with time decay and and volatility moving in the right direction, this will start profiting. So we're going to look at this a little bit more in detail. We're going to go back and take a look at some of these trades. This one is not yet completed. So as we go forward another couple of weeks, we're going to see where it is now and see where it gets to. And we'll be able to back test. I'll have more opportunities out there as well that we're going to be looking at. So I've got to wrap this up. Unfortunately, we're running out of time here, but I want to kind of open up. This is a little bit of an idea of what we're going to be doing. Again, I did a little bit of education. We're going to dissect more individual securities and trade opportunities in the future. We didn't have a whole lot of them available at this point, but that's the market. Sometimes there's lots of opportunities. Sometimes there's just a few. And if you have questions, let me know. We'll go ahead and wrap this up. I see Jesus back on the mic here. I want to thank you for giving me a little bit of time. And again, I'm going to be showing you step by step what was going on during the markets at the time that we got into this position, whatever it may be. We'll go through what's the good and bad things about the position and how we can go ahead and manage the position that we're in.
Yeah, I'm looking forward to that, FNF position and see how it's gonna play out. So next time that we meet here, September 30th, we'll have an opportunity to do so, just to recap and see how it did. So this is a calendar spread, right?
Yes,
Brandon?
Yeah, this is a long calendar spread. It was a long call calendar spread actually on FNF.
Okay, perfect. It's a good thing that we have, access to the workspace. Actually, that workspace is still not on the. Is it on the web?
Not quite yet. That one's going to be probably up next week, I believe. Yeah, so I got a little ahead of myself there.
It's okay. It's okay because on the 30th, September 30th, we have also a special presentation. We have a guest speaker from the OIC, the Options Industry Council, and he's going to talk about calendar spreads. So the workspace that Brandon was talking about is going to be available very soon, and an article also explaining calendar spreads. But it's great that we had an opportunity to see, the calendar spread in action. So in terms of the recording, it'll take us, a couple days to edit it, run it through compliance, make sure that everything is good to post, and just go to the Options Education Center. Actually, no, we didn't. Did we decide to put it on the Options Education Center? I think we're creating a whole separate section for the options replay, but we are going to definitely make those recordings available to everyone. And that way there'll be a connection, from class to class, and you can follow these trades as they play out. All right, but Brandon, great information. Thank you for sharing with us, and we look forward to the next class. Do we have any idea of what is the next class is going to be, or it all depends on what the market brings us this next couple of weeks?
A little bit on what I'd like to do is a couple of just simple strategies, taking a look at some of the debit and credit vertical spreads. So we're going to take a kind of a dissection of and compare back testing. I'll do the same type of strategy, or sorry, different strategies on the same security, and that way we can take a look to see why one worked versus why one didn't. So for instance, we might do a bull call spread and a bull put spread. One's a credit, one's a debit, and we can see why one might work out better than the other and figure out what's better for us as traders and how we can identify the better opportunities potentially. So that's what we're going to be doing next.
Great stuff. And I know very good. And I see some last minute questions here. For example, backtesting option strategies. This is a little bit of backtesting because we are pretty much, putting on a strategy and then we're looking back to see how the strategy worked. TradeStation does not have back testing as you would do on regular stocks or futures. But I think we can do a little bit of back testing by just looking at prior trades, right, Brendan?
That's what we're going to be doing. I mentioned that I'm going to be doing screen captures when I'm putting on the positions as well, to kind of walking through step by step. Okay, post-mortem, what did we see? What did we like? What worked well? What didn't work? Again, probably the best way to kind of see this 3 steps would be going back and saying, okay, this is what we did. We put on a bull call spread and a bull put spread. And why did one work well? Why did the other one not work as well? And try to figure out, okay, what environments do we need to identify to put on the best strategy that we can at the time? So yeah, we're going to be seeing that. As far as another question real quick, why would the bid be larger than the ask? Because if they were the same, then the specialists, the people who are creating the liquidity in the markets, could never profit. That spread difference between the bid and the offers are typically the profit that the person who's creating the liquidity in the markets gets to keep for creating that liquidity. So that was an easy question for you. Yes, I can put this back up. There you go.
But the question is why the bid would be larger than the ask. Usually,
why would the bid be larger? It typically wouldn't. If the bid is larger than the ask, then that's a skew you could actually try to take advantage of. It's called arbitrage. But it probably most likely would be a delay on your data coming in, and it's not real. If it is real and you can take advantage of it, then great, but not always.
Yeah. All right. Well, Brandon, I think we're going to call it a day today. And this is the first instance of this options replay. So I hope you guys enjoyed it. And I hope to see everyone next class. Remember, this is a recurring class. So I think that by registering today, you're automatically registered for the series. You should be getting those reminders for September 30th, where we're going to, do options replay again. Brandon, thank you so much for your time.
Yeah, fighting a head cold, so I appreciate you guys having me here.
And everyone that is logged on here, please, mark your calendar for next time. I look forward to seeing you in one of our future classes. Goodbye, everyone. Great seeing you today. Bye-bye. And by the way, if you haven't left, I just submitted a poll. Please take a few or a couple minutes, to answer some of these questions. It'll help us guide education. So if you're still on, take some time to answer some of these webinar poll questions. Thank you so much.